Historically, real estate has been the best hedge against inflation, even in high interest rate environments. I've crunched the numbers on real estate markets across the country, and the trends are clear. Here's what you need to know. Hi, my name is Tarlika Sehgal and I'm a real estate expert. A common phrase we hear a lot is, now is a great time to buy because interest rates are low. But what does that mean for you as a home buyer? I have been in real estate for a while and I have worked with plenty of first-time buyers who focus on interest rates without fully understanding their real impact. We often see numbers like 3%, 4%, 5% and consider them small percentages. But in reality, even a 1% difference can mean thousands of dollars over the life of your loan. So today we will break down exactly how interest rates affect your monthly payment, how much house you can afford, and why locking in a low rate could be one of the smartest financial moves you make. So let's dive right into it. Starting with number 5, affordability and monthly payments. Buying a house means you borrow money and pay interest on it. A small change in the interest rate can change how much you pay every month. For example, if you have 200,000 loan over 30 years, a 1% increase in the rate can add about $100 more to your monthly bill. That extra $100 might not seem big at first, but over many years it adds up to thousands of dollars. This means you may have to settle for a smaller or less expensive house because you cannot pay as much each month. This shows why rates matter. Over a long time, 1% rise in the interest rate can make a huge difference. With the extra cost, you might pay tens of thousands of dollars more in total interest. This extra money can change your budget and force you to cut back on other things you enjoy. You may need to think twice about buying a house or spending on fun items. It is important to plan well and understand how even a small rate increase affects your overall cost. By knowing these facts, you can make smarter choices when buying or investing in a home. Coming in at number 4, loan qualifications and buying power. When you want to buy a home, the bank looks at your debt to income ratio. This means they check how much money you earn and how much you spend on paying debts every month. If you earn $5,000 a month and pay $1,500 for debts, your ratio is 30%. When interest rates go up, your monthly mortgage payment gets higher. This makes your debt number go up too. So if you planned to borrow $300,000 at a 4% interest rate, a rise to 5% might lower the amount you can borrow to about $275,000. The bank does this to make sure you can pay all your bills each month. When your monthly payments go up, your home buying power goes down. This means you may not be able to buy as big or as expensive a house as you thought. With a higher interest rate, you might have to look for a smaller or cheaper home. You may even need to change your budget or cut back on other things you like. By understanding how interest rates work, you can plan better. This helps you know what to expect when you borrow money for a home. Moving on to number 3, long-term cost of home ownership. When you buy a house, you borrow money and pay extra money called interest. The interest rate is the extra percent you pay each year. If you borrow $200,000 for 30 years at a 3% rate, your monthly payment is about $843. But if the rate is 6%, you pay about $1,199 every month. This means $356, much more than the earlier price. Even though it is $356, sounds not much, but it turns out to be a lot in the years to come. Over 30 years, the extra cost of a higher interest rate can be huge. With a 3% rate, you pay less extra money overall, but at 6%, you might pay over $100,000 more in interest by the end of your loan period. This shows how a small change in interest rate can affect the total cost of owning a home. It is important to look for the best rate when you borrow money. A lower rate makes your home more affordable, helps you save a lot of money in the long run. Coming at number 2, investment property cash flow. When investors borrow money to buy houses, higher interest rates make the cost of borrowing go up. This means they must pay more money each month. For example, if an investor borrows 300,000 at 4% interest rate, a jump to 5% could add up to 150 to the monthly payment. When the monthly payment is higher, the investor gets less money left over. This extra cost makes it harder to pay for repairs or save money. In other words, higher interest rates hurt cash flow, which is the money left after paying bills. In the long run, higher rates can slow down and investors plan to grow. Many investors borrow money to buy more properties. When rates are high, the cost of borrowing makes it tough to afford new homes. With less cash flow, investors may also have to cut back on fixing up old houses. This means they have less money to improve or buy more properties. In the end, high interest rates make it harder for investors to earn money and build a bigger portfolio. Moving on to number 1, market trends and buyer demand. Interest rates play a big role in how people buy and sell homes. When rates go up, borrowing money becomes more expensive. This means that monthly mortgage payments are higher and fewer people can afford a house. With higher costs, many buyers hesitate and the market slows down. First-time home buyers feel this the most because they have little extra money. As a result, fewer houses are sold and prices may drop or not rise as quickly. This change in the market shows how important it is to watch interest rates carefully when planning a home purchase. It truly does matter. On the other hand, when interest rates are low, borrowing money is cheaper and more people can buy homes. Lower monthly payments make home loans easier to manage, which boosts buyer confidence and demand. A busy market can drive home prices up because more people are competing for fewer houses. This situation is ideal for sellers who may get higher offers. Understanding these trends helps you decide the best time to buy or sell. If you plan and follow interest rate changes, you can save money and get a better deal when trading homes. That is smart. Let's talk about the bonus tip, refinancing as a future strategy. Refinancing your home can be a smart move when interest rates drop. It means you change your current loan to one with a lower rate. A lower rate can cut your monthly payment. For example, if you have 200,000 loan at 6%, switching to 4% may drop your payment by about $240 per month. This extra saving helps you pay for other needs. You may also choose a shorter loan term like 15 years instead of 30 years. Even if your payment is a bit higher, you pay off your home faster and spend less on interest. In some cases, cash out refinancing lets you borrow extra money from your home's value for repairs or other costs. Consider refinancing when rates fall much lower than before. If your credit score has improved, you may get a better rate. Refinancing makes sense if you plan to stay in your home for many years so you can save more over time. Always speak with a trusted expert to understand the costs and benefits. With careful planning, refinancing can lower your payments, build your equity faster, and help you make your home more affordable in the long run. This is a very smart money-saving choice. If you found value and would like to see more videos, click on the boxes on the screen. If you would like to know about the Toronto's real estate, then please subscribe to my YouTube channel and follow me on my socials to keep yourself updated. Hit the like button if you found this video informative. Once again, I'm Tarlika Sehgal, your real estate expert, and you can get in touch with me through my contact details in the description box below. See you in the next video.